In the first half of 2025, Wendy's market value dropped $2 billion overnight. What started as a routine earnings miss spiraled into a chain-wide crisis no one saw coming. That $2 billion vanished from investors' portfolios, from the retirement funds of franchise owners, and from the wages of thousands of crew members. If a fast food giant can teeter on the edge, the same market forces could threaten any business you rely on. Understanding Wendy's downfall isn't just a history lesson, it's a warning for your own financial health. So how did a company that once seemed untouchable crumble so fast? The rise. Wendy's went public in 2001 and quickly became the third largest burger chain in the United States. By 2022, the brand boasted $11 billion in annual revenue, a net income of $354 million, and a market capitalization hovering around $7 billion. Its fresh, never frozen slogan resonated with millennials. An aggressive international expansion added over 500 new locations worldwide. The warning signs, but beneath the glossy ads, cracks appeared. First, a surge in labor costs. The federal minimum wage rose to $15 per hour in several key states, squeezing franchise margins. Second, the company's heavy reliance on franchisees meant that any debt they carried was effectively Wendy's liability. Third, a series of supply chain disruptions in 2023 forced Wendy's to pay 12% more for beef and potatoes, eroding profit margins. Analysts at Bloomberg flagged tightening operating leverage in their Q3 2023 report, but the warnings were buried under upbeat earnings calls. The turning point, the decisive blow, came in February 2025, when Wendy's announced a $500 million write-down of underperforming franchise assets in the Midwest. The write-down was triggered by a lawsuit filed by a coalition of franchise owners alleging that Wendy's had misrepresented projected sales figures. The company's CEO, Todd Penegor, tried to downplay the issue, saying the impact would be short-term. But the market reacted instantly. Wendy's stock fell 22% in a single trading session, wiping out $5 billion of market cap. But it gets worse. The collapse within weeks. Credit rating agencies downgraded Wendy's debt from A to BBB+, citing heightened default risk. Banks tightened credit lines, and several franchisees announced they could not meet lease payments. By April, Wendy's share price had slumped to $15 per share, a 55% drop from its $33 peak in late 2024. The Wall Street Journal reported that Wendy's had lost $2 billion in market value since the February announcement. In May, a class action suit filed by former employees alleged wage violations and forced unpaid overtime, adding legal fees estimated at $120 million. The cumulative effect was a cash burn rate of $250 million per quarter, far exceeding the company's operating cash flow. That was the easy part. The aftermath. By August 2025, Wendy's announced a restructuring plan that included closing 250 underperforming locations and renegotiating franchise agreements. The CEO resigned, and the board appointed an interim leader from the restructuring firm, Alex Partners. Shareholders voted to approve a $400 million rights offering to shore up liquidity. Several franchisees filed for Chapter 11 bankruptcy, and the brand's reputation suffered a permanent blow. Consumer surveys showed a 12-point drop in brand favorability. Yet, Wendy's survived. It emerged from the crisis with a leaner operation and a renewed focus on digital ordering platforms. So what can we take away from Wendy's collapse? Lesson 1. Franchise debt is a hidden liability. When you invest in a franchised brand, the health of individual owners directly impacts the parent company's balance sheet. Lesson 2. Supply chain shocks amplify existing weaknesses. A modest increase in commodity costs can tip a tightly run operation into the red if margins are already thin. Lesson 3. Regulatory and legal risks can accelerate a downfall. Lawsuits that expose misrepresentations trigger immediate market panic and can lead to rating downgrades. The executives didn't set out to fail. Most believed they were building a lasting brand. The difference between them and you is awareness, and that's exactly why you're here. If today's story made you rethink the stability of the stocks you hold, consider a platform that gives you clear, commission-free trades and real-time risk alerts. Webble. Sign up through the link below and enjoy 90 days of free trades, an extra layer of protection for your portfolio. And if you want more deep dives into the biggest financial disasters that shape our markets, hit subscribe. We publish a new breakdown every week, and you won't want to miss the next one. Criminal or just reckless? Tell me below. Save this video so you don't forget the lessons.